Have you ever actually looked at the rands in your wallet and just wondered what they really are? I mean, beyond the paper and the metal, there's this whole massive, complex system working in the background, giving that money its value, its power. Today, we're going to pull back the curtain on that system, all the way from your pocket to the very top. So let's start with the most basic question of all.
Right? It seems so simple, but the answer is pretty fascinating. Because on its own, a banknote is just a fancy piece of paper. Its real power, its value, doesn't come from the material it's made of, it comes from what we all agree it can do. And to really get that, you kind of have to imagine what a world without it would look like.
So before we can even talk about the value of your rand, we need to get to the heart of what money's purpose even is. I mean, why did we invent this stuff in the first place? Well, it all comes down to solving a really old and honestly, a super inefficient problem.
Okay, picture this. You're a fantastic baker, but you need new shoes. In a world with no money, a barter world, you'd have to find a shoemaker who not only has shoes in your size, but who also happens to be hungry for your bread right at that moment. It's a logistical nightmare. Money just solves all of that. It's the universal middleman that everybody accepts. And, unlike your bread, it doesn't go stale.
So, economists have basically boiled this down into three core jobs that anything has to do to officially be called money. First, it's a medium of exchange. That's the go-between we just talked about. Second, it's a unit of account. This just means we have a common ruler to measure value. So we can say a car is worth, say, our 300,000 rand and a loaf of bread is our 20. And third, it's a store of value, which means you can stick it in a savings account and it'll still be there to spend later.
All right, so that's the theory. But in our world, today, where does all this money actually live? It's not all just stacked up in bank vaults. Let's follow the money from your hands right into the modern financial system.
First up, you've got the stuff that's literally in your hand. This is called fiat money. It's the official cash, the notes and coins printed by the South African Reserve Bank. It's what's known as legal tender, which is a fancy way of saying that, by law, people have to accept it if you're paying off a debt. It's really the physical bedrock of our money supply.
But let's be honest, most of the money we use day to day isn't physical anymore, is it? It's deposit money. When you get your salary, it usually just appears as numbers on a screen in your bank account. And you get to it with your cards or you move it around with EFTs. This digital money is where most of the action happens.
And this is where things get really powerful. See, banks don't just sit on your money, they put it to work. The money you deposit becomes the raw material for someone else's home loan or for a new business to get started. This whole process of turning our deposits into loans is called credit creation, and it's basically the engine that drives the entire banking system and the economy itself.
So, if you've got all these different commercial banks out there creating credit and moving money around, you have to wonder, who's in charge of the whole show? Who's conducting this massive financial orchestra? Let's zoom out and meet the conductor.
And that conductor is the South African Reserve Bank, or as you'll usually hear it called, the SARB. It is the country's central bank, and it sits right at the very top of that financial pyramid, keeping an eye on everything.
The SARB has a huge to-do list. I mean, it does the basics like printing our cash and acting as the main bank for both the government and all the other commercial banks. It also has the massive job of keeping the country's finances stable, which means holding on to our gold reserves and being the lender of last resort if a bank gets into trouble. But its most critical job, the one that affects you and me every single day, is controlling the money supply to protect the value of our rand.
And that right there brings us to the SARB's most important battle. How does it actually fight to make sure that the rand in your pocket tomorrow can buy you pretty much the same stuff it can today? Well, this fight is against an enemy we are all very familiar with.
That enemy is inflation. You know the feeling. It's when the price of everything, from petrol to a loaf of bread, just seems to keep going up. And as those prices rise, the purchasing power of every single rand you have goes down. Your money just doesn't stretch as far.
So how do they even measure this? They use something called the Consumer Price Index, the CPI. The easiest way to think about it is like a giant imaginary shopping basket filled with all the stuff an average household buys. By tracking how much the total price of that basket changes over time, we get the inflation rate. And if we look here, comparing the basket's price from July 2021 to July 2022, we get a very specific number.
7.8%. Let that sink in for a second. What that means is, in just 1 year, the average cost of living shot up by nearly 8%. To put it another way, every single rand you had saved lost almost a tenth of its buying power. That is a serious knock, and it's a huge red flag for the Reserve Bank.
Now, that 7.8% is a big deal because the SARB has a very specific goal. Its main job is to keep inflation inside a target range, somewhere between 3% and 6%. So at 7.8%, we were way outside that target, and that's the signal that the SARB needs to step in and put the brakes on the economy.
So how do they do that? What's their main weapon? It's something called the repo rate. That's the interest rate the SARB charges commercial banks when they borrow money. So, if the SARB raises the repo rate, it suddenly gets more expensive for your bank to borrow money. And guess what? They pass that cost straight on to us. Interest rates on home loans, car loans, and credit cards all go up. And when it costs more to borrow, people and businesses tend to borrow and spend less. That slowdown cools the whole economy down, which helps ease the pressure on prices and brings inflation back towards the target.
Okay, so this whole system is designed to be a well-oiled machine, creating stability. But it's an incredibly complex machine with a lot of moving parts, and, sometimes things can go wrong.
It's the question that nobody really wants to think about, right? What happens if you go to your bank or the ATM and they just can't give you your money? It's called a bank failure.
And it can happen for a few reasons. There's the classic bank run, where panic spreads and everyone tries to withdraw their money at the same time. But since the bank has lent most of it out, it just doesn't have the cash. It can also happen if way too many people stop paying back their loans, if the bank is just managed really badly, or if the whole economy hits a major recession.
But, and this is important, there are safety nets. This is where that lender of last resort job comes in. The SARB can step in with emergency loans to keep a struggling bank afloat. If things are really serious, they can even appoint a curator to take over and manage the bank, and their number one priority in that case is to protect the money of the people who have deposited with them.
So, there you have it. From a simple solution to the problem of trading bread for shoes, all the way to this massive interconnected system of central banking and fighting inflation. It's a system that's ultimately built on trust and very careful management. But as we look ahead into a world of cryptocurrencies, global shocks, and brand new technology, it leaves us with one final and really crucial question. Is this system we've just walked through actually built to last?